Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining us. Today is our episode 19 with Nic Espanet, and we've seen a lot of you here before, but if you're new here, our focus is how to get started as a syndicator. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. Welcome everybody. My name is Marcelo Cazini. If we haven't met before, my background is in IT and software development with an MBA from Texas A&M. I'm a local Houston CCIM member. Without the CCIM designation trainings, I'm a multifamily investor, and I also own and operate my own commercial real estate. In real estate, before multifamily, I was also involved with single family fix and flips.
Hello, everybody. My name is Claudia Rubio, and I was born in Colombia in South America, and I'm a commercial real estate investor. Martin and me, are based out of Houston, and I have a real estate professional, an architecture degree, and my background in asset management comes from managing our own assets in Colombia. And I hold a National Apartment Association certification. And you go ahead.
Okay. So I'm Martin Rubio. I'm an IT security consultant for the last 25 years. My background is on business management and consulting. I've had my own businesses for a long time. We've had businesses together with Claudia related to real estate back in Colombia. And we got involved in multifamily a couple years ago. Up to date, we have invested in around 800 units passively and actively. We syndicated our first deal in December last year here in Houston, and we like to learn and as much as possible and meet everyone we can in this space.
All right, perfect. Thanks, Martin. Nic, do you want to take a minute and introduce yourself?
Sure. This is Nic Espanet, and first of all, thank you guys for having me on. I appreciate it. The opportunity to get to help you guys out and be part of what you're doing here, and I appreciate that. But so I'm Nic Espanet. I've been doing multifamily for about 4.5 years, and I started out through a mentor program, Brad Sumrock, as they mentioned. My background before that was in healthcare. I was a physical therapist that did contract physical therapy, and just started out looking for something different to put my retirement. So I started initially looking for single family stuff, but it is that we're picking up another video, or is that me? But then through looking at single family, came across Brad's multifamily program. I think I'm getting somebody else's.
Yeah,
there's
definitely a lot of background noise.
Okay.
Yeah, I muted somebody, so I think we should be good now.
Okay.
If you could just mute all, that'd be awesome.
Okay.
Yeah.
So what I was saying is that I joined Brad's group in February of 16, and started out just passively investing, and then was able to close my first syndication in February of 2018, which was a 100-unit property in Abilene. And I did that with my business partner, Brad Abbott. And then he and I closed a second deal in Abilene in December of 2018, a 124-unit property. And then in August of 2019, we closed a 228-unit property also in Abilene. We didn't set out to get all of our properties in Abilene, but it's kind of worked out that way. I think we know the market well. So when something comes up and we like it, we have an advantage. We can scale our property management. We can share employees, use part-time employees scattered across, 20 hours per property or 15 hours per property, something like that. So it helps us with costs. And we know the market for what we think we can get on rent. We can tour now with our regional or one of our more stellar managers, and they can give us, I think you can get this amount. And then, we do that with the rent comps to see what we can get. So I think we can dial our numbers in quicker. And, the third property, we made a preemptive offer, and we're able to get it before it went full market, which was helpful because we didn't want to get in a bidding war. We actually bid over the whisper price because the return still worked at that price.
Excellent. Thanks,
You
Nick,
just
for
mentioned
the
that you
intro.
were going to start, when you decided to start on real estate, you were going to start on single family, right?
Yes.
And how did it?
Can you guys hear me?
Yes.
Yeah, we can hear you okay.
Okay. No, we're good. I've got an hour-long Zoom call, so let's just get to the truck. All right. So if single family, I never actually made it through to single family. That's what I learned about multifamily and started going down that avenue and just seeing how I would be able to scale it. And it wasn't, I wouldn't have to put all the work in to do the, like I would on the single family. You know, I like to say for all three of our properties, we don't even have keys. And I wouldn't know what to do if a toilet needs fixed other than call somebody to fix it. Mm-hmm. So that, you know, having just being able to do that with multifamily over the single family, having to take on all the jobs myself and then having difficulty to scale it.
Okay. So other than scaling, what else about multifamily attracted to you?
I really like that it could scale easily, that you can, you can, other than when you're in the acquisition process and maybe the first 3 to 6 months after taking over, you can leave for a month or two. And, you know, with me having a partnering with Brad Abbott, I could leave for 6 months and he could run everything and take care of it. And my income would keep coming in from the properties. You know, I'm not planning on leaving for 6 months, but, you know, if I wanted to plan a long trip with my family, I could do that. And I think y'all have had Justin Martinez on before, and he is, you know, he's traveling the U.S. in a van with his family just to be able to do that. And he still has income coming in from the real estate. Now he flies back occasionally and takes care of his properties, but he's going to spend a year in a travel van with his wife and daughter. You know, just to have the freedom to do something like that just is very appealing to me.
Yep.
Closing on a 419 unit property from a travel van, traveling the country. It's American.
Yeah.
Exactly.
Yeah, but being cooped up with your wife in a travel van for a year, I'm not sure I'd still be married.
I mean,
I hope your wife's not on the call too at the same time.
It's still COVID, so it's either in your house or in a van. Same thing. Yeah. So Nick, is not here on the question.
No. Maybe 6 months, but or just being able to go to like Clayton, you guys were off in I think Grand Teton or Yellowstone, somewhere like that. But being able to go and spend 2 weeks or a month, it's a Ford truck. Okay, oops, sorry. Okay, guys, I'm unloading my stuff now. Can y'all still hear me?
Yeah,
we can hear you.
Okay, awesome. I'm going to get my stuff out of the player, so it'll be quieter in the truck.
Mm-hmm.
Okay, do you want us to pause for a second?
Yeah, well, if y'all can keep just kind of ask it. Yeah, no, I can keep going. It won't take us but a couple of minutes to get loaded up here.
Okay. So it's not on the typical questions that we ask, but you mentioned your partner, Brad.
Yes.
So do you guys, like, on a strategy for someone who's starting out, looking for the first deal and looking for that partner that they want to start working with, do you have specific roles, like one of you is more in acquisitions and the other one more in operations, or do you guys split all the work evenly?
Yeah, no, good question. We started out pretty much both doing acquisition and just not really having defined roles, and it's worked out now. We both work on. Anybody need water? Work on acquisition side, but it's our roles that's running the properties have kind of defined or split up to where I do more of operations and Brad does more lender relations.
Mm-hmm.
Okay.
And then I handle the investor relations. I type up the emails, newsletters for our investors every month. And now Brad looks over them. But so, we have defined it up. He and then I kind of oversee the rehab as part of the operations. I deal with the contractors. And then Brad is more taking care of it, everything that needs to be done with the lender. If Brad all of a sudden disappeared, I would not really know what to do with the lender. I'd have a big steep learning curve.
Mm-hmm.
And we didn't set those out. That's just how they kind of naturally shook out.
Okay.
But I think definitely having a partner, it can be done by yourself, but I think it would definitely, you would have a big challenge.
Yeah, I think that's a critical piece that we don't touch on too much on these ones, on these meetups, the partnership, which I think is really, really important. So can you talk a little bit about how you, how did you decide Brad was a good fit for you to be a partner with? Did you complement each other in some way, or what did you see in each other to be able to say, okay?
Well, I think one of the first things as a partner is being able to just get along. You know, we got along, and so we just underwrote deals for 6 or 9 months together, and didn't plan. I mean, we talked about partnering, but Brad was about 9 months or a year longer into the program than I was. And so at first, I went and toured some properties with him, and you know, if we got a deal, I wasn't even planning on getting any portion of it. And then we got to where I was.
Oh, we're losing you.
We're losing you.
Hey, Nick, we're losing you a little bit. Are you moving?
Get like 5%. And then after, I don't know. Once I felt, he at some point said, I think you're doing enough of this now. We can split 50-50. And so I push stuff sometimes, and he'll say, no, I think that's a little too much. And it's nice to have that level of compliment too. And and then it worked. He's handling all the lender side, and I'm handling the operation side, because I had done.
Oops.
I mean,
Nick, we lost you.
A little bit of rehab stuff before. It's kind of become my. Uh-oh.
Can you hear us?
We're moving now. I may fall off here. Hear me off and on.
Yeah, it's
so it's breaking up a bit, Nick. We can't hear you too much.
Okay. How about you guys carry on, and when I get to a better signal, I'll jump back in.
Okay, it seems like it's better now. I think we can hear you now.
Can you hear
Are
us?
you?
Okay, let's
give
keep
him a couple minutes until he gets to his car. So no, I think that's a good topic to start introducing with guests that started with a partner, because in our experience with Elaine, that's really a breaking point. Nick, are you back?
Can you guys hear me?
Yeah, we can hear you. Can you hear us?
No.
Nick, can you hear us?
I'm in out as a rule, but we're moving back towards town, so.
Claudia, or
Hey, Nick, do you wanna join just via audio instead of joining through Zoom? So you just need the voice.
since we're talking about partnerships, maybe Marcelo or Claudia and Martin can talk about how they connected with their partners and the division of responsibilities while Nick gets
Sure. So I think, while Nick gets to a better signal place, we can do that. So in our experience, I think, I'll let Claudia speak a little bit about that, but I think it happened organically. We were not looking, we wanted to find a partner, but we were not looking for a specific partner. But I think it's very, very important. I've talked about the 3 buckets several times. One of those, and we can talk about that more in detail later, but one of those buckets is everything that you identify that you need and you don't have and you cannot build. So for example, let's say experience. That's something you cannot get from one day to the next. You need to be doing this for a while. Or sometimes it's money, or sometimes it's network. Sometimes it's net worth. It depends, but those things that you cannot build yourself, you're gonna need a partner. But it's also a balance in which that partner is gonna want to have something in return that you can provide to them that they either don't have, or you can provide and make their life easier. So it happened organically in our case that we found that match. But the first important thing is what Nick mentioned, that there needs to be chemistry, right? It needs to be someone you get along with. You're not gonna be fighting about something in 6 months. It's a marriage, right? It's a 5 year, at least 5 year marriage. So you don't marry the first person you meet. Like you have to go look for partners until you find.
Wait a minute. What's this 5-year marriage deal? I mean, what kind of plan is that? You know.
Well,
Yeah.
Wait, I want a 1-year marriage, a 2-year marriage, come on.
you can exit it earlier if it goes really well.
If it goes really well or really bad. Yeah. But
No,
I'll let Claudia talk about it.
It was very important for us, the networking portion, to be able to get. I think we were thinking of networking for just finding investors and just meeting people. But like in the beginning, we were not thinking about finding a partner there. We joined the group, and the amount of people you meet in this group, it's amazing. Like there were a lot of people in these events. So that's how we got to know a lot of people that we started recognizing we might match, and they did the same with us. So that's how Alain, he approached us and he said, hey guys, I want to expand to Houston because Alain's, all of his deals are in Dallas, and he wanted to start just expanding, and he was interested in this market, and he reached out to us and in one of these events. And it was surprising for us because we were still building like our team and starting, and then he came to us and he said, would you like to partner up with me? And so that was amazing. We didn't have to do much effort other than just being there for networking, being at every single event, meetups, every single thing that will show up, we will be there. And that's how maybe we had more exposure to him. And we just, it was just like a magnet. So that's why it happened to us.
Yeah, but I think one caveat I would say is a lot of people say find a deal, and then when you have a deal, you're gonna get partners easily, you're gonna raise the money easy, and you should have all of that identified before. If you find partners when you have the deal, that's when I've seen cases in which they don't get along, they have problems. And I just saw Jan was mentioning on the comments that she's seen partnerships that go bad, and that's one of the main reasons, right? They haven't really thought about it, and they just got together because there was a deal to invest in. Yeah.
And on the other hand, if you have the relationship in advance and then find a deal, maybe that's better. I mean, they works both ways, you know. But you want to be with people you want to be with, and so either way.
And for us, it was very important to find somebody that had the experience we didn't have, because the responsibility you hold when you're a co-sponsor or a syndicator is huge, and the portion of experience, it's one of the most important parts. So we were willing to work, we were willing to learn, we were willing to keep networking and finding deals and everything, but that portion of the experience, we cannot gain it fast. So trying to find a co-sponsor or a partner that has the experience that we don't have, it's very important. So Alain holds our hand whenever we need help or we have questions. He's there for us. So that's super important.
Nick, are you back?
Yeah. Yes. Can y'all hear me?
Yeah,
we can hear you. Perfect.
So going back to the questionnaire, when you started looking,
I muted myself. Can you hear me now?
Yeah,
yes.
We can hear you.
Yeah, we can hear you, Nick.
Okay. No, that was you know, having a more experienced partner is great. I mean, just having a partner that's reliable, just because you're splitting up the work. It's not a buy it and sit back and do nothing. I said you can go off and do the long vacations, but especially when you're early on and you're inexperienced, everything takes longer to do. So you know, just having somebody to work with goes a long way, and that allows you to leave town and not really have to think about it unless there's a big emergency. So being able to team up with a more experienced partner. We partnered up with Dustin Miles on our first deal, and he'd had, I think, 7 deals at the time, so that really helped. It gave us credibility as buyers, and then we had him to bounce things off of as we were learning the market and the process.
Okay. So
and I think Clayton, did you have a question about the partnership? I saw you raising your hand there.
Oh no, I might have missed this. I don't know, Nick, if you said it, but are you guys both not geographically co-located with your investments, or is your partner local and you're in the Metroplex, or are you both in the Metroplex? I didn't know.
We both live in West Fort Worth, about 2 hours from Abilene.
Okay.
So we can be out there pretty quick. Now, we do have local ties. Brad went to Abilene Christian, and his mom and dad live in Abilene, and my father-in-law lives in Abilene. So we do have both families, my father-in-law and Brad's parents, have invested in us.
Okay. Yeah, thanks.
So I buy and check on things, to see how if there's any problems.
Mm-hmm.
Found that these had carports, but it's being utilized. But my father-in-law drove through there like at 5 in the morning. See how many cars were.
No.
He had to do it for.
Yeah, you're breaking up again, Nick.
Oh, sorry. You know what? We just in a really low area. Is that any better now?
Yeah, a little bit.
Yeah, it's better.
So when you started thinking about multifamily after looking into single family, the first thing I assume is get educated on the space. Did you go straight for a program like Brad's, or did you try to learn on your own? What was that first approach, and what do you recommend others to do to get educated?
I got a book first, but I didn't feel like I was getting anywhere. Then I went to one mentorship program, and I liked it, but I didn't join all the way, and I knew Brad's program was coming in a couple of months, and my wife and I decided we'd wait and attend that. I'm really glad I did. I think, he focuses only on multifamily, whereas the other program was multifamily and single family. So being able to get somewhere in a program that they've already made the mistakes with a lot of things, you can, having a mentor goes a long way to be able to help you, have to learn by spending money. Yes, we're paying for his education, but at the same time, we're I think, prevented making much larger mistakes.
Right.
And then when you were ready for looking for that first deal, I know you were looking in Dallas and also in Abilene. Would you recommend for a first-time syndicator to look at those secondary and tertiary markets?
I wouldn't advise against it. I think the main thing is just pick 2 or 3 markets and know those markets well. If it's Houston, you may want to pick, or Dallas, just 2 or 3 submarkets within that area and try to focus. Or, it sounds like we're looking at the secondary, tertiary markets like West Texas is, you just don't have much deal flow out there. So you really need to almost know about Amarillo, Lubbock, Abilene, San Angelo, and West Texas. And then, East Texas, Longview, Tyler, and some of those smaller towns along there are, smaller, but 100K. So you have to, you do have to spread yourself a little bit. But I think just knowing 2 or 3 markets, because I would say Brad and I took a little longer because we were trying to look in too many places for a while. And, each time we had an opportunity in a new submarket, we had to go and learn about the job growth, just learn all the things, and that now that I can almost recite all that stuff about Abilene on a pretty consistent, tell you what the job growth is, tell you what the industries are. And,
Yeah, that makes sense. So tell us about the first deal that you guys syndicated. So, how big was it? What class was it? What kind of demographics? And was there anything in particular that attracted you guys to that deal?
I don't think he's
Oh,
there
and
anymore.
yeah, I think it just this. So hopefully he'll dial back in.
I think we lost him. Yeah. Marcelo, did you have any input on the partnership? Have you tried that? What are your thoughts on that?
Hold on, I was just IMing him, make sure he knows he disconnected.
Okay.
Yeah, I agree with you guys. I think for me, it's about finding skill set that complement each other, right? Because I've seen some people who they say, "Oh, I'm very good at underwriting," and then they try to partner with somebody who's also very good at underwriting, and in that case, it's not complementing skill set, and you make it more difficult. Instead of finding somebody who, okay, if you know nothing about construction, maybe they bring the construction knowledge. If maybe there's somebody who has more access to money, and then they can be the money person and the raising money person, and you can be the boots on the ground. So it's really coming up a team that, number one, you know, you like, and you trust, but also bring a different skill set to the partnership instead of finding someone that's just going to mirror yourself, right? So that's something that every time I'm talking to somebody who's new, and they're like, and I always ask them, what of the three-legged stool there you're going to bring in terms of skill set? Are you going to be finding the deal? You're going to be evaluating the deal? You're going to be operating the deal? You're going to be raising money for the deal? So really find somebody who is going to be adding value to the partnership, and how you can also add value, right? So I think a lot of times people try to co-sponsor with a more experienced sponsor, and I feel like if you want to find an experienced sponsor, then what are you going to bring to the table to make it worth the experienced sponsor to partner with you? So maybe if you are in a particular market, maybe you can be the boots on the ground, and then you shouldn't be looking for an experienced sponsor in that same market. Probably want to look for an experienced sponsor in a different market, because then they can have you as boots on the ground. Because if they're already there, then they already have all the relationships with the brokers. So really finding that complementary skill set.
And that is something that's important to for the passive investors, for them to understand the same what's the synergy among the co-sponsors. So when you have it clear for you, you can project it, because that's going to create a lot of credibility for you with your investors if you have a team that have all the pieces together. So the partnership goes way more farther than just partner up with somebody who you, all the things that we're talking about, just to project it to the passive investors. That's important too. Does anybody have any questions? Until we...
And Nick, do I see that you are connected back again?
I am back. Can you guys hear me?
Yeah, now it's pretty good connection. So before you disconnected and before I ask some question from the chat, I just want to let me repeat the question that I think you got disconnected there. So can you just tell us about that first deal that you syndicated? How many units? What kind of class? What demographics? And specifically, as a first-time syndicator in that particular case, what were some of the characteristics that attracted it as a first-time syndicator? And Nick, it sounds like you're muted now. Okay, go ahead.
Oh yeah. So that first, it was Brad and I doing our first deal. We were trying to find something out of the box that, I don't know if you the Blue Oceans book. It was something that was in a demographic, in a submarket that had growing population and job growth. But so it was a mom and pop property, so the financials were not in order at all. So we had to really piece things together but there was a lot of meat on the guy that owned it, I think, for 17 years, or maybe it's 13. And so he had done all the repairs himself in-house, and we just saw a tremendous opportunity. There was one of the challenges were most people are on month-to-month leases because he hadn't been increasing rents. So there was a lot of room to move the rents up as we rehab unit. It's a kind of a unique property. It's all one floor, and it's mostly one bedrooms. It's a 94 one bedrooms, 6 2 bedrooms, and so we market it more to seniors, and so we have with it all being one level, no steps in it, and so the great thing about seniors is they don't move, and through COVID, a lot of them are on fixed incomes, so they're not losing they didn't lose their jobs. We actually raised rents in May and June, and it stayed at I don't think we've dropped 97% in probably 9 months at that property, and they keep a waiting list for people wanting to move into it. So it's been a great opportunity. What attracted us? So one was the proximity. With us being on the west side of the Metroplex, we're able to get there. We didn't have to fly. That was one of our things we were looking at initially. And having family in the area actually helped if we needed something, and just something that would cash flow early on. That's our first deal, and had very strong returns to be able to get in there, and so we can make our first impression.
All right, yeah, that makes sense. So as a follow-up of that, I had a question on the chat here that as you were looking at secondary and tertiary markets, what was your approach for finding a property management company? Did you have somebody refer them, or were you just going there and evaluating every one of them? So what approach did you take to find a reputable management company?
Well, we ended up using Wayner, who a lot of people in our program use, Wayner Multifamily, but we also, before we picked them, we looked on apartments.com. You can look at most of the other apartments have listed who their property management company is. And we also just talking with the brokers early on about who they knew that operated in that market, and just and then we would visit the properties to see if they were clean, if they looked like they were being run well. And it's hard, because everybody puts on their best mask when they're interviewing the property management company. So it is a challenge. On our first deal, we had to fire a property management company 6 months in because they couldn't keep staff. We were having to use contract labor on everything. So we decided about at month 4, but it took almost 2 months to get them, have everything. The lender has to approve it. There's a lot of, you can't just fire them and have the new company come in the next day. You have to get lender approval and fill out the paperwork and things like that.
So Wayner was already in that market, right? So it wasn't your property. Correct. It wasn't the first one.
Correct. They had 2 others. No, I'm sorry, 1 other out there. And that is one thing we've decided, that the first company we used had no other footprint there. We will not use a property management company that doesn't have at least 1 other property, preferably 2, in the submarket already. So they know the contractors, they know they have employees, they just have connections. Our first property management company didn't have any Abilene connections.
Got it. And Clayton, I think you had a follow-up question.
No, Marcelo, you actually asked it. I was going to ask about, in the major Texas MSAs, there's these buckets of well-known property management companies, and that question about how you identify a property management company in a secondary or tertiary market. The follow-up question I had, Marcelo just asked it, was, did Wayner already have a presence there? Were they breaking into that market? Because I think, obviously local knowledge of, contractors and, staffing for things like maintenance, et cetera, is really important. So thanks, Marcelo. You beat me to the punch on that.
Yeah, that is exactly right. Having somebody that already knows, plus if they have another property, you can share employees and somebody's out, they're able to help one another out.
Yep, makes sense. So Nick, one of the things from our meetup is mostly people getting started and trying to get to their first syndication or maybe to their next syndication. And you mentioned that you've been doing coaching now for maybe a couple of years for a program. So what is you think your best advice for somebody who is maybe they've done passive deals, but now they're trying to break into being a sponsor or a co-sponsor, especially on the market that we are right now? What do you think would be your best advice for somebody starting now?
I think it's what one of you guys were saying when I got back on is, if you can find a partner that's more experienced and bring value to their team, either by being local to a market, being able to raise money for them, just bring, adding some value. That's Brad Adam and I've done. We have a couple of different teams that we work with that are looking at markets that are out of state or different places in Texas that we can't get to real easy. And they underwrite a deal, and if it starts looking good, we come in and do a second review of their underwriting, and then we'll try to if it's in Texas, the guys that are out of state, we will go tour it and get more information, and then we'll make the offer with them and let them be the asset managers, but be there to coach them. But we will take part of the sponsor portion of cut.
Okay, yeah, that makes sense. And in terms of evaluating a deal, I know a lot of folks have been asking us about underwriting as one of the skills that is very important for somebody getting started. So, and especially when there is now the deal flow is not as much, but when a time hopefully that picks up and you have more deals to evaluate, do you have any special recommendation or techniques for analyzing deals, things that you typically look for or watch for as you get a broker package?
I think right now the broker packages are very optimistic on other income opportunities, and I think some of them are possible. In the past we've used those fenced-in yards, covered parking, valet trash as more icing on the cake. Sometimes the OEM may have that you can get all those things, but if you're adding 3 or 4 different other income charges plus a $50 rent bump, that may be more than your tenants can tolerate. So just being careful on being overly aggressive on other income items is probably, maybe do a little bit, but for the most part, to get all of them is probably not realistic. And then also your, carports, you can go collect all that day one, but anything else that goes with the lease, you're only going to be able to bring in maybe 40% year 1, 40% year 2, and 20% year 3. Because you got to renew them. It's going to take you 2 or 3 months to get things going. Then as your lease is renewed each month, you can add those charges onto the into the income side. So not thinking you're going to catch them all day one.
Yeah.
And anything in terms of surprises? I mean, positive or negative? The 2 big ticket items are always taxes and insurance, especially in Texas. Any surprises, positive or negative, from taxes and insurance from maybe when you underwrote a property and when it became reality?
I think that's for having the value of a renter, because we were taught to go and get quotes from a tax professional and from an insurance quote quickly as we could. So we were, from our underwriting, we did well. Now this year our taxes have gone up between 30 to 60%, depending on the property. So that was a big surprise across. But I think that's hit everyone, at least in Texas, just due to the all the claims that have happened recently. And then we actually, a positive thing is on Cedar Creek. We now nobody go and tell us, the appraisal district never realized we sold the property, so they evaluated our property as the same price it was before we bought it. So we're $2 million below our purchase price, or say, I don't know the exact number, but that's been a nice. And we haven't bothered to protest because we don't want to draw any attention that we've bought the property.
Yep, that makes sense.
So that's that was a nice positive surprise that we hadn't underwritten for. But the the insurance increase offset any savings we're having there.
Nick, we have a question. Actually, that's one of the questions we usually ask our guests. Knowing what you know now and with your experience, the experience you have now, is there anything that you will have done differently on your first deal?
On the first deal?
Yeah.
Not right. Well, we would have started with Wayner as our property management company. I think would have been one of our biggest things. As far as on the underwriting side, not that I can think of. I mean, I think having someone to guide us through the mentorship program helps us, avoid those pitfalls that if somebody was trying to do it on their own without a mentor.
That first property management company that you used, why did you choose it? Was it the one that was managing the property before, or why did you choose that one instead of Wayner first?
When we first, they had a property in Abilene at the time, and they had more in Amarillo, which was another market we've been looking at. And they had we had been speaking with the owner. Well, part of it was he sold the business, sold the company through the process, and we started dealing with somebody else who was not as responsive, and just they had, in the year or so that we'd worked with them, they sold their other property in Abilene and lost all their contacts there, and so and that's how we ended up with them. So now we if we say, I don't think Wayner's in Amarillo, so if we got a property there, we'd use somebody different.
Okay.
I don't even know that if they wanted to expand there, that we would be their test dummy.
Yeah. So Nick, when you get a deal for you to analyze and pursue, what would you consider deal killers? Things that you will discard immediately?
I wouldn't buy any household median income under 30,000 or only 32,000. I don't think we would look at within 1 mile median household, not average. So that would be most likely a more rougher part of town. Any crime, so we try to look at the higher crime areas, which that usually comes with your income levels. It's something that's under, we mostly focus in Texas. I wouldn't buy anything really, I don't right now. And there's a few other, Oklahoma, I just haven't, there's some people that have had luck there. But that would be the biggest thing, just crime and being in the hood.
All right, and for you, the determination there would be you find that the 32,000 medium income and 1 mile radius is what really you try to avoid.
Yeah, that's one of the first markers that it's probably you're just going to have higher turnover, higher delinquency, bad debt, trouble on your property. I think it's just what makes it a hard, that's just a red flag to start with.
Yeah.
Do you have any property characteristic that's from a demographics perspective? I think that's a very good point on the median income. Is there any particular property characteristic that you tend to avoid? Maybe age, or maybe something else on the property itself?
No, all of it can be remedied. Aluminum wire. We've got a property in a flood zone. We made offers on properties with aluminum wire. We just factor in having to replace it or remediate it. I'm not concerned with a boiler, chiller, or even a roof. If you just plan on replacing them and put new ones in before you take over, if they're too old, and they should last the 3 to 5 years old, or even the 7-year old.
How old are the properties you have in Abilene?
Mid 70s on 2 of them, and one's mid 80s.
Okay, so you have flat roofs on those 70s?
Yeah, no flat roofs. We have pitch roofs on all of them. No boilers and chillers. Individual HVAC. So that is definitely nicer. But I'm not opposed to boiler chiller property. mean, my biggest concern is old sewer lines that could be crumbled. So just being able to check those is important. You can look at their plumbing costs and look for signs of sewer lines backing up around the property when you tour.
Okay. So when you got that first property and you got to that first achievement, which is very fulfilling, how long did it take you to stabilize that property and go looking for the second one? How long did you guys take on that?
Nick.
Nick? Do you hear me? No, I think we lost you, Nick. Can you hear us?
Oh, yeah, here I am. We know what? We drove up beside my car and you went to my GPS. You guys there?
Yeah.
Yeah, we're here.
Get away from my car.
Okay. Did you hear the question?
Yeah, we got back to where my car was, and so it jumped to my car. All right.
Yeah, the Bluetooth.
What was the question? I started answering it. You went away.
So when you got that achievement of your first property, how long did it take you to stabilize that one and go looking for the second one?
6 months. We were probably 3 to 6 months because we had, and I think it would have been quicker, but just having a bad management company. Another one came available in Abilene. We closed them 10 months apart. So we started looking around 6 months, and we're able to close another one at 10 months later.
Okay.
And did you have any surprises on stabilizing that deal? I mean, you always underwrite with certain income or certain rent growth. Did you find any surprises trying to stabilize it, or did you find that you pretty much was able to execute the business plan with no problem?
Let me get you unlocked. No, other than the management company not being able to handle things, it went pretty smoothly. And I think if we would have had a good management company, we would have been in a much better position instead of having to deal with the chaos for 6 months of not having a good manager, working contractors.
So are you using Wayner for all 3 properties now? Nick, are you using Wayner for all 3 properties, or how are you?
No,
Nick,
we lost him.
can you hear us? He's there. Nick?
Can't hear you.
Yeah, he's talking to someone.
No, I think
Guys, you went back to my Bluetooth. Let me unplug that, and so it'll quit doing that. So our last deal went. There we go. Unplug. Okay, so the last one, we've had it for 6 months, and we haven't got the income growth we wanted. We've had it for a year, but for 5 months of that has been COVID, so we haven't been able to do our rehabs like we wanted. There for a while, we couldn't even get people on property. And so that we're about 10% behind on our collections of where we projected we would be. And so, but it's I've learned that we have a plan for every property, and then as Mike Tyson famous says, then you get hit in the mouth. But anyhow, you got to expect something's going to go a little silly.
It switched again.
Okay, let's wrap it up.
Nick, your Bluetooth may have picked up again.
I wanted to ask. Yeah. Oh, the market analysis.
Nick, can you hear us? No. Nick, you there?
No.
Big thing is always make sure don't try to give distributions out when you're not. All right. Sorry about that. I'm going to stay away from my car. I thought I'd unplugged it. So don't try to make sure you have cash reserves to float any issues that come up while you're when things like COVID, or if you have a bad manager, that your occupancy drops. But because over time, if you do enough deals, something like that's going to happen.
So Nick, do you have the same property management on all 3 properties now?
Yes, being out in Abilene, it's been, Wayner's work. They had private equity come in, and they've had some different operations people, so they've stepped up. We have all 3 properties out there, and they brought in a regional that just serves Abilene. Wayner has 2 other. Right now, they have 5 total properties. So we have a regional that is from Abilene, lives in Abilene, and just handles our properties, our 3, and then 2 others. So she has been just a tremendous asset on knowing what's going on, because she's on every property at least weekly, if not 2 or 3 times a week.
Awesome. You want to ask me?
Yeah, I wanted to ask you, Nick, do you use any platform for market analysis? How do you analyze the market behavior?
You mean, using like CoStar, or
yeah.
we will do our own rent comp. We will go visit properties 3 or 4 times a year, try to go visit the comps ourselves. I mean, Wayner runs comps through, just calling, but we like to go in and kind of just pop in and make sure that they're where they are, because, if they're, even a good property manager is going to, hopefully they're pushing rents, but it's a lot easier if they're occupancy looks good, and but if you could be getting $10, $20 more per unit, but it may make it harder for them to sell. That we may have to insist to try that little rent bump. So if we're just trusting them to do our market surveys, we could be completely off. We may be missing some meat on the bone.
Yeah. Right.
And I think, Clayton, do you have a question?
Yeah, just real quick, Nick, like you had that first deal managed by Wayner, and as you brought on the second deal in the same submarket, third deal in the same submarket, you were able to leverage your relationship and your existing, contract with Wayner to get, presumably better economy of scale and pricing and coverage from those guys. But have you at this point moved to like a master contract that umbrellas all your properties, or are they each kind of considered independent and you're leveraging the scale of your relationship in more than one property in the same submarket?
They're independent leverage. Now we're now, our first deal, we were 3% management fee. When we had 2, it's 3.5, and now we're at 3.
Okay.
Which it's not across our portfolio, but it is on the 2 newest properties. So it helps those. We tried to push them to get it across every property, but they didn't go for it.
Is that something that when you come up for like a renewal thing, you could negotiate, or is there any benefit to go into like a master agreement? I
don't know if we hadn't explored that. That's a thought, but if we got ready to sell one, I don't know how that would. Yeah. Would we renegotiate at that time?
That's true. I think
they're each one is a different LLC that owns it.
And I think we got a question from everybody in the group here, Nick, if you know the answer to, but does anybody know a good property management book that they would recommend if somebody's trying to learn more about it? Leah was asking that question.
There is our regional told us a book. I think it's that she wanted our managers to read, and I don't. If you guys email me that question, I will try to reach out to her and find out what that book. I think I looked it up and it's out of print, but you can still find it digital. It's been a year or more since I've done that, and I don't recall the name. But if you send me an email, Martin or Marcelo, I will when I'm back in town, I will or a group message. I will see if I can find that information.
Okay.
All right, perfect. We'll do that, and then we'll post it on the meeting.
Okay.
For everybody to see.
Just to complement that answer, Leanne, Carmina, the certification I got from the National Apartment Association, it's exactly about that. It's about how like property management.
Okay.
You learn the basics of what the property management should be doing on site. Like it is for you to learn how to manage your property, but I just did it for me to be able to learn what are the tasks that the property management should be doing. So you want to learn, you can, you can just Google the NAA, the National Apartment Association, and that's a course anybody can take.
Oh, I love that idea. And you know what? I have actually started down that rabbit hole and then never finished trying to find something like that to sign up for. And can you do them online?
Yes.
Okay. Yes, I have looked at that. It's a few $100. It's $700 or something.
Actually, I guess that during these days they are only doing it online. They used to do it. I took it online, but I know that it's a 3-day course, I think, when you do it in person. But you can take it online and just do it as you at your own pace, and then you have to take an exam and pass it to be able to get a certification. But the most important thing is that there's a lot of information there about those minuscule things that the property management have to do, like all the filigree of the day-to-day things that happen at the property, and the management has to take care of.
Just as an example, for example, today I was thinking about asking our property management to do something with our tenants and just to send that communication to some of them. And before that, Claudia told me, because of her Arab studies, that you cannot do that because of housing
discrimination.
Yeah.
Right. You have to communicate to absolutely everything for fair housing. So those are things that the property management should know. And you should know. You don't need to know because you're the asset manager, but it's really helpful when you know it. It helps you speed up decisions, and it's really interesting.
Yeah.
No, I think that's a extremely valuable tool to have, and knowledge to have.
Yeah.
And Clarissa, did you have a question?
Yeah, I know we're at the end of our time here, but I just wanted to ask Nick when we're going to eat them dubs. I'm trying to time when I'm loading up the truck to get out of here.
Hey, man, well, I'm taking these home, but we'll. I don't know what they're feeding us. They've got a big tent over here. I need to go find out what they're serving. But hey, now this is actually a neat place. Where we're staying is in an old missile silo from the Cold War. It's the barracks that the troops stayed in above ground, and then the silo's still there. There's a hole in the ground with no missile in it, but it's kind of a neat thing to check out.
You just need to buy a property, Clayton, and then the brokers are going to take you every weekend.
Hey, I'm working on it.
Exactly. It's a great opportunity. Yeah, I got to come to this. This is actually our insurance company that has all our properties. Oh, somebody's talking. Let me get away. And then one of the brokers we've bought a deal from, and maybe buying another deal from before too long, also invited us out. So I'm sorry, I walked up and they were making speeches. All right. So great. Well, I appreciate you guys giving me the opportunity to come on. I'm sorry it was kind of glitchy. But we got through it, and I hope everybody had value. I'd love to connect with anybody if they want to reach out with an email or questions. I don't know. Martin, do you guys share contacts?
Yeah.
Marcelo,
yeah, we shared, and I'll post it again in a second here. So I just before we do that, Nick, just 1 second. I just wanted to ask everybody. I posted the link to our YouTube channel there. So if you guys can subscribe to it, and then you miss one of our live meetings, you can always get the recordings. So if you guys don't mind subscribing to our YouTube channel, that helps us getting more subscribers there. And before I share Nick's contact information again, I just want to remind everyone that we always meet on the first and third Wednesday of every month at the same time, 7 o'clock. So the first Wednesday, like today, we're focusing on getting started as a syndicator. And then the third Wednesday is getting started as a passive investor. And even if you're not interested in getting started as a passive investor, it's always important to know what a passive investor is looking for as a syndicator. So I always recommend joining both of the meetings there. And with that, Nic, I just put your background on the screen again and your email address. So yes, for sure, I recommend everybody to contact Nic if you have any other questions.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.